The Federal Reserve announced Wednesday it is raising interest rates by 3/4 of a percentage point. That is the sharpest increase since 1994. The Fed previously suggested it was likely to boost rates by 0.5 percentage point, but record high inflation spurred policymakers to move more aggressively to combat rising prices. Fed Chair Jerome Powell says a similar hike could come next month. Meanwhile, U.S. stocks soared Wednesday after the announcement. All major indexes finished the day in the green. The Dow Jones added nearly 304 points, as the Nasdaq and S&P 500 also reported gains. Our Carter Evans has more from Los Angeles. Carter.
That's right, Matt. With this rate hike today, the Fed chair signaled the central bank is meeting this inflation crisis head on. It's a bold attempt to throw cold water on a white-hot economy.
It is essential that we bring inflation down.
The aggressive move from the central bank today is urgent, according to Fed Chair Jerome Powell.
Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
The last time the Fed raised rates 0.75% was in 1994, when inflation was only 2.7%.
In the Fed's view, there's too much spending going on.
Nick Bunker's an economist with job search site Indeed.com. This is a different position than the Fed had just a couple of months ago.
Exactly. Their expectations haven't come true, and inflation is now very high, 8.5%.
The Fed's move today will make borrowing money more expensive. With rate hikes of 1.5% already this year, a loan for the average new car price of $47,000 will cost almost $60 a month more in interest than last year. More expensive loans could discourage spending and reduce the insatiable demand now driving inflation to 40-year highs. But higher interest rates won't lower gas prices, now over $5 a gallon nationally. Today, President Biden called on 7 U.S. oil refiners to ramp up production and stop making historically high profit off Americans. The painful price increases are already too much for some people on fixed incomes, like 70-year-old Bonnie Gilbert in Omaha. Her husband died last year from COVID.
Now I'm not going to be able to retire, because how am I going to retire with just a Social Security?
To make ends meet this month, she's having a garage sale. In Pasadena, California, this 47-year-old single mother who didn't want to give her name relies on a food bank.
So every time I get a paycheck, I make sure that first the bills, and then see what my child needs.
Is your paycheck enough to get by these days?
No.
That's why you're here.
Yes.
For her, the cost of living in the Golden State is now unbearable. Are you considering leaving?
Oh, yeah. Goodbye, California.
Well, high prices might already be having an impact on consumer spending. It declined unexpectedly in May. As for home prices, the Fed chair says a lack of inventory might keep prices high, despite the fact that mortgage rates are now close to 6%. Matt?
Carter Evans, thank you. For more, I'm joined by Megan Greene. She is the global chief economist for the Kroll Institute and a senior fellow at Harvard Kennedy School. Megan, thanks for joining us. This interest rate hike affects borrowing costs. What does this mean for people who are planning to buy something like a home or a car or even have credit card debt?
Yeah, so regular people, you're right to point out that it really affects mortgage rates. It affects credit card loans. It also affects car loans. And so it will just make these things more expensive. It's worth pointing out that's the whole point, actually. The Fed can't do anything about supply side shocks like Russia invading Ukraine and higher energy costs. It can only deal with demand. And so what it's trying to do is tamp down demand so that it's not so out of whack with supply and prices will come down.
Right, one big seesaw. So consumers who have an adjustable rate mortgage or home equity lines of credit, what should they do at this time?
Yeah, so they're stuck facing higher mortgages. The mortgage rate tends to track the 10-year yield, actually, not the policy rate, but the 10-year yield, of course, is based off of inflation, plus some kind of term premium to include risk. And so if you think that the Fed will succeed in actually tamping down inflation, that suggests that mortgage rates shouldn't go that much higher from here. If you think that the Fed won't succeed, then they probably will go higher. And so you should worry about these variable rates and look to fixed rate mortgages.
Yeah, I think a lot of people are worrying right now. Let's talk about federal student loan borrowers. Those payments have been paused through August, which has been good news for those borrowers. But what happens after that? That's only a couple months away.
Yeah, so it depends on fiscal policy there. And what we might end up is seeing a sort of cliff where student loans end up coming due. And it's all of a sudden this massive amount for students. And so that also will tamp down demand. And that's not down to the Fed so much. That's down to fiscal policy and what the government decides to do about these student loans.
So you hinted at this earlier. Chairman Powell said the Fed is likely to continue to raise interest rates this year. But the big question, how high could we see these rates go?
So the neutral rate, the rate at which, unemployment should be at full employment and growth is at potential, its long run potential is 2.5%, according to the Fed. The Fed itself expects that rates will actually go up much higher than that to roughly 3.5% by the end of this year. What we know from the history of Fed rate hiking cycles is that the Fed tends to have to hike rates above the neutral rate in order to tamp down on inflation. So I do think we'll have to see rates go higher than 2.5%. 3.5% seems likely. We'll see whether markets push against that and push that even higher. Then next year, the Fed expects to hike rates a couple times more. And by then, they hope that some of the supply chain issues that we've seen, both in terms of global supply chains, but also in terms of the labor supply with people dropping out of the labor market because of COVID, will abate. And that should help actually keep inflation down a little bit. So as we go into the end of this year, as the Fed's leaning on the demand side of things, the supply side could abate, and we could end up seeing inflation come down on its own. That would be a so-called soft landing if the Fed can pull this off without pushing us into a recession. The Fed's record on that isn't very good. It's only actually managed that 3 times ever, and unemployment was much higher actually in these previous 3 instances. And so I think it's really unlikely that the Fed's going to be able to hike aggressively, lean against inflation, and not have a huge impact on unemployment and growth. We have 11.5 million unfilled jobs in the U.S., so I think there's a way to go before the labor market really starts to deteriorate. So I'm not worried about a recession in the next 12 months. It's the 12 months after that where I think the risk increases.
Yeah, looking to the future. Finally, stocks have been selling off for weeks over concerns about the inflation and that interest rate hike, but the market actually went up after the Fed announcement. So what does this mean? Can you make sense for just the average American who's listening to this?
Yeah, so I think what that's about is that, the Fed went out and hiked by 75 basis points, and suggested this might happen again at the next meeting. But what the chair said was actually, this isn't going to be normal. We don't plan on hiking by this much all the time. And I think that's what the relief rally is based on. I don't expect it to last, actually. I think concerns about inflation and about a potential recession will reassert themselves. But that's what the rally was about.
All right, Megan Greene, thank you for making all that make sense. We appreciate it.